All right, folks. Welcome to Presario's Investor Education Series. I'm Tom Burns, and really excited to introduce our guest tonight. And I'll do that here in a few minutes. So normally I would be here with my partner, Darren Davis, but as I say on the nightly news, he's on assignment. So Darren and I, as well as the whole Presario team, we're all kind of lifelong learners, and we like to share the good stuff with you. So this is just part of our series that we've done live before. We've done quite a few by Zoom over the last few years, and I often find I always learn something when we do this, and hopefully you will too. So for those of you that are new to Presario, we're a private equity real estate firm. Over the past few years, We've transacted 2,600 units. Our average return's been a 2.6x return with an average four and a quarter year hold. So as you can see, primarily in the multifamily space, and we're real proud of the track record and real proud of the investors that have come along for the ride. So it's been a great partnership, and we hope to continue that for many years to come. Now I'm very excited to introduce our new guest. Tom Wheelwright is a tax and wealth expert. He's a CPA, the CEO of Wealthability. He's a rich dad advisor, entrepreneur, international speaker, and the best-selling author of Tax-Free Wealth, How to Build Massive Wealth by Permanently Reducing Your Taxes. He recently released his newest book titled The Win-Win Wealth Strategy, 7 Investments the Government Will Pay You to Make. Tom is the CPO for Robert Kiyosaki of Rich Dad, Poor Dad fame, and has spoken on stage on every continent to over 100,000 entrepreneurs, small business owners, and investors. He's also the host of 2 popular podcasts, The Wealthability Show with Tom Wheelwright and The Wealthability for CPAs show. Tom's goal is to help people achieve their financial dreams faster by permanently and legally reducing their taxes. He's a contributor to Entrepreneur Magazine, and his work has been seen in Forbes, the Wall Street Journal, the Washington Post, and on Fox and Friends, Marketplace, NPR, ABC News Radio, and hundreds of other media outlets. His greatest claim to fame is that he is my good friend and my CPA. And I can't tell you how much money that I could count how much money Tom has saved me on taxes. Tonight, he's going to educate us on taxes, in particular how they relate to real estate. And with a little luck, he will teach us a little bit about the potential benevolence of the United States tax code. So with that rocky but heartfelt introduction, I'm going to get Tom to come join us now.
Well, hey, good to be with you guys. Always good to be with Tom. I don't know if they know this, Tom, that you bought the very first copy of Rich Dad, Poor Dad. And that's actually how I met Tom, is that he was actually presenting that back to Robert and at a little gathering where Tom and Robert had kind of reconnected. And I thought that was an extraordinarily generous gift that you made to Robert. The very first copy ever sold of Rich Dad, Poor Dad was Tom Burns.
So it's hanging in the office now.
So there you go. So thanks for that introduction. Thank you for those nice words, Tom. So a little bit more of my background. I grew up in Salt Lake City, Utah. So as a good Mormon boy, I spent 2 years in Paris learning how to get rejected in French. Which is good for every investor and entrepreneur to know how to do. And then I spent a couple of years at the University of Utah to do my undergraduate degree in accounting, another year and a half at the University of Texas, there in Austin, where Tom is, to do my graduate degree in accounting with a specialty in tax. And I spent 7 years with Ernst & Young, one of the largest CPA firms in the world, including 3 years in their national tax office. There, I actually was creating an education for the CPAs and teaching CPAs. That's what I did while I was there. Then I joined I came back. I actually moved to Arizona. That was in Washington, D.C. I moved to Arizona as part of their real estate tax practice in Arizona with clients such as Trammell Crow and some very, very large real estate clients. From there, I actually joined a Fortune 1000 company because they had just recently bought a real estate development company and they needed somebody who understood real estate tax. And I was there for 4 years. And from there, I decided to, I did a short stint back in public accounting with a different big four accounting firm, which didn't work out well for either of us. And I decided to start my own company. So 13 years into it, I started my own firm. At the same time, I'd been asked to teach at Arizona State University in their Masters of Tax program, where I was an adjunct for 14 years. And about 5 years into my new CPA firm, I was looking for an accounting firm to acquire, and I found one. And one of the clients happened to be a fellow by the name of Robert Kiyosaki of Rich Dad, Poor Dad fame. And that's how I met Robert. So since then, he's been very gracious and included me in many, many of his travels over the last 20 years. And we have literally traveled every continent, 30 countries around the world. What's been interesting is, so I always get to look at the tax law in every country we go to, right? Because my job is to support him from a tax standpoint. How does the tax law support what he does? And it's really interesting because it literally, I've had this in Kazakhstan. I've had this comment to me in London. I've had this comment to me in Santiago, Chile, and in Dallas, Texas. And the comment is always the same. It's like, they come up to me, they're a little afraid of Robert, but they come up to me and they say, Tom, so this is really great information. The only problem is you can't do that here. And I get that all the time. And so what I want to share, and what Tom and I have talked about me sharing, is really what can you do here, wherever you are in the United States. Frankly, it works everywhere in the world. In my new book, Win-Win Wealth Strategy, I actually cover 15 different countries and talk about that. But what I'm going to do is I'm going to just share my screen for a little bit so you don't have to just look at me. And I know we're recording this. So let me share my screen. Let me kind of walk you through kind of really the fundamentals of how the tax law work. And I always start with Robert's second book. So first book, Rich Dad, Poor Dad, everybody knows that. Second book, Cash Flow Quadrant. And I think Cash Flow Quadrant is equal in importance to Rich Dad, Poor Dad. Rich Dad, Poor Dad changes your mindset. Cash Flow Quadrant tells you what to do. There we go. So if you look at the Cash Flow Quadrant, what Robert says is that there's really only 4 ways to make money, right? You can make it as an employee. You can make money as a self-employed superstar, small business. You can make it as a big business, or you can make it as an inside investor, right? A professional investor. What's interesting as I travel around the world is, it doesn't matter what country I'm in, but how much tax you pay, the rate you pay, is largely dependent on how you make your money. So if you make your money as an employee, you're likely going to pay 40%. It's the way it is in the US, top rate of 40%. It's the way, frankly, it is in most countries. If you're self-employed, then you actually get to pay the employer share of the tax too. So you get to pay an additional 20%. So that's your privilege as a self-employed person. As a big business owner, though, all of a sudden you find that your tax rate drops down to 20%, which is, by the way, why Warren Buffett famously said that he pays less taxes than his personal assistant, his secretary. Well, she's paying 40%, he's paying 20%. And then, of course, we have the Tom Burns bracket, which is 0%. And this is for inside investors. This is what people who make their money investing, this is how much tax they pay. Now, you go, why is this the case? Well, the reality is we're all partners with the government. And I want you to think about that just for a second. In fact, you probably want to write that down. We're all partners with the government. So you write down, I'm a partner with the government. You don't get to choose whether you're a partner with the government. You just are. It's part of being a citizen of Earth. You get to be a partner with the government. What you do get to choose, so you got to choose whether you're in the game, but you get to choose whether you win the game or whether you lose the game or whether you even participate, how much you participate in the game. See, you can actually be, you get to choose. You can be a silent partner with the government. Now, a silent partner with the government, every week, 2 weeks, month, they get a paycheck from their employer, or they get income from their small business, and they have to pay out tax. And they just automatically pay tax. They don't think twice about it. They just pay the tax. That's a silent partner, right? That's what silent partners do. They don't get any say in what's going on. You could also, though, be an active partner. And an active partner, all the active partner does is say, look, whatever the government wants me to do, I'll do. And if the government wants me to put my money a certain place, I'll put it in that place, and the government will give me a tax benefit. So let me give you some examples. And I'm going to go through 3 in a little bit more detail. But when you think about it, what does the government really want for the economy? First of all, they want jobs, right? Big businesses create jobs. Now, good news is small businesses create jobs too. So really, you can actually get this tax rate in a small business. You just have to know how to do it. What else? Government wants technology created. If you look at Amazon, Tesla as 2 good examples, they didn't pay tax the first 20 years of their existence. Why is that? Well, because they created jobs and they created technology. Then you have in the investor quadrant, you have housing, which is what Tom and Presario do. You have food, right, that the government wants. And you have energy. So the subtitle of my new book, The Winning Wealth Strategy, is 7 investments the government will pay you to make. Well, 5 of them can only be done by a business owner or an investor. You can't get them as an employee. Now, employee, there's a couple of others. There's retirement plans and there's life insurance. But those 5 are limited to business owners and investors. And so what I want to walk through is 3 of them. I'm going to walk through, I'm going to walk through this one, this business, housing, and energy, because they all go together. All right. So if you think about, I'm going to stop sharing for a second. So if you think about being a business owner versus being an employee, let's make this really simple. If you're an employee, let's say, I don't know, there was a pandemic and you had to work from home for a couple of years. So you had this office in your home and you had your computer and you were doing that. As an employee, you got absolutely no tax benefit for having that office in your home. None at all. But if you owned a business or were a professional investor, you got to deduct all sorts of things in your home office. You got to deduct part of your house. You get to deduct your equipment, your furniture. You get to deduct your automobile, all sorts of things. Why is that? Well, simply because the government has made a conscious decision that if you make money and you put it back into your business or you start a business, then they're not going to tax you on that money. What's important to understand is there's 6,000 or 7,000 pages of the tax law. It's just like it changes almost daily. And there's one line that says all income's taxable unless we say it isn't, basically. And another line that says nothing's deductible unless we say it is. And then there's about 20 some odd pages of charts and tables to tell you how much tax to pay. But there's another 6,000 pages. What's that for? Well, the 6,000 pages is to tell you actually how to pay less tax. It's actually a guide or a code. We call it the Internal Revenue Code. It's a code that you have to decipher to pay less tax. So we've had a lot of discussion over the last couple of years about how the rich don't pay tax and Donald Trump doesn't pay tax and so on. The question is, well, they're just a bunch of cheats, right? Well, not in my experience. I've known a lot of rich people. All my clients are rich people. And Not one of them cheats. So how do they do this? Well, really, they're just active partners with the government. So they've decided either to invest in jobs, technology, housing, or commercial property, agriculture, or energy. And by doing that, they've lowered their taxes and sometimes down to zero. So let's take a look at how that actually works. I'm going to come back and show my screen again. Let's look at how do we actually do that? And let's start with business. Okay. Well, in business, basically, you think about it. Here's your financial statement. Here's your income statement. Here's your balance sheet. We have income and expense. We have assets and liabilities. Well, if you earn income and you either spend it or you save it, then you pay tax on it. But what if you don't do that? What if you take the money that you earn in your business and you put it back in your business? Well, you put it back in the business, there's no tax whatsoever. Well, what if you buy an asset for your business? So you actually put it down here and buy an asset. There's still no tax. So as long as you're putting the money back into the economy, other than through the stock market, doesn't work in the stock market except through your 401k, but otherwise you keep reinvesting your money. You're not going to pay any tax on that income because that income immediately becomes deductible. So you can look at business that way, and that's true in every business expense. So business is the fundamental of all good tax planning is business. So if you don't have some kind of a business or you're not invested in some type of a business, you're probably going to pay high tax. But let's look at real estate as a business, because when Tom and Darren are working on the real estate, they're not looking at real estate simply as an investment. They're looking at real estate as a business. So they're basically operating the business and allowing you, the investor, to invest in their business. And that's really all that's going on. Now, because they've decided to do such a tax-advantaged business like real estate, then instead of being a regular corporation like Apple is, or Tesla or one of these other big companies, they decided to be a limited partnership or a limited liability company to allow you as the investor to get the tax benefits. So that means that even though you're not actually doing the work, you get the tax benefits that go along with the real estate. So let's look at what those tax benefits are. Well, the big one, of course, is what we call depreciation. And depreciation, there's a little bit of magic in my book, Tax-Free Wealth. I actually call it the magic of depreciation. And depreciation is simply a deduction for the wear and tear on the property. Well, let's say you've got residential property. Well, residential property doesn't last quite as long as commercial property because it gets a lot of daily use and nightly use, and it's probably used at least probably 3 times as many hours as commercial property. So we say, well, this is going to probably wear out over, say, government says 27 and a half years. Okay, so that means we're going to get about 3.6% per year as a deduction. Well, that by itself, that'd be great, right? I mean, we've got a building going up in value that we're getting a deduction for at 3.6%, but we can do better than that. We can do better through what's called a cost segregation. And a cost segregation is where we go, well, wait a minute, we're not just buying the building. What else are we buying? Well, first of all, we're buying the land, right? Well, land doesn't wear out, so we're not getting any deduction for that, but we are buying it. So we do have to separate it out. We're also buying the land improvements. So we're buying the trees and the shrubs, and we're buying the lighting and everything that goes along with it. So that's actually wears out faster, according to the government, 15 years. But then what we're also doing is we're buying what's inside the house. We're buying the ceiling fans. We're buying the window coverings, right? We're buying the cabinetry, right? We're buying everything that goes in the house. Well, that wears out a lot faster, like 5 to 7 years. So basically you have 27 and a half years, you have 15 years, and you have 5 to 7 years. Only guess what the government decided? They decided that's not fast enough. So it's not enough for you to get 7 to 20%. We want you to get close to 100%. So what they did was in 2017, they enacted a law called bonus depreciation. Bonus. And with bonus, you get to take most of this deduction in the very first year. In 2000, prior to 2023, that was 100%. That means if you had $1 million building and $300,000 was your land improvements and your contents, then you got a $300,000 deduction the very first year. Well, this year it went down to 80%, phases out over 5 years. So next year it'll be 60%, then 40%, then 20%. You still get these for the rest, right? You still get the 15, 5 to 7. You do a cost segregation. But that's kind of the magic of real estate from a tax standpoint. This is how the government pays you to buy real estate. Literally, with bonus depreciation, you can end up with more tax savings than you put money in. I know that's hard to believe. We don't have time to run those numbers, but I've run those numbers 100 times. And you literally, the government will pay you to make that investment if you do it right. Now, you need a good team. One of the advantages that the rich have is they have great accountants and the great attorneys. And so they're able to, they don't have to know everything. They just have their accountants and attorneys who know everything. Okay. But the average person can do it as well. The reason I wrote Tax-Free Wealth in the first place was so the average person would be able to learn this stuff and then take it to their accountant and have their accountant learn it. So their accountant then can help them with it. Well, in the meantime, what I found is the most common question I got as I traveled around the world, Tom, was where do I find somebody like you here? And that is the number one question I get. And so what we decided to do 5 years ago is we sold our CPA firm and we decided to form a network of CPA firms and train other CPAs. So now, really 4 years after we started, we're up to 65 CPA firms around the US and Canada. And these are the people that I trained. They use my system. They use our system for reducing their taxes and building wealth. And the reason is because the tax law is it's a little bit like the weather. We can easily predict the weather now for the most part. Why is that? Well, because there are patterns. We call them weather patterns, right? In the weather. And so the meteorologists have figured out a formula based on those patterns for predicting the patterns. And then they just create a system that just does it over and over again. Well, what we've done is the same thing with the tax law is once you understand the patterns, which one of these is, guess what? There are certain investments the government will pay you to make. Once you start seeing those patterns, then you can develop a formula, which we've done, and then you can have a system. And once we have a system, now we can train accountants how to use that system, right? We can't train them how to do all the things I do, but we can train them how to use our system to reduce taxes. So number one is business. Then you add on real estate. But what we just have this great opportunity now where we have a new opportunity, and that is the solar panels. And we get to add energy to our real estate. So we actually get to use 3 of the 7 primary investments the government will pay you to make just on our real estate. So we've got business, because real estate is business, investment real estate is business. We have the tax benefits from real estate, like depreciation. And then we've got these energy tax benefits, if we choose to do them, where we actually can put solar panels on our investment properties And not only do we get a 30% tax credit, but we get a deduction of about 65% of the cost of those solar panels in the very first year. So literally the government is paying anywhere from 50 to 70% of the cost of those solar panels. And that's how we get the government, again, to pay for our investments. And this is not, we're not talking about something that is a loophole. It's not something that, it is the result of lobbying. Absolutely. It's the clean energy lobby, right? I mean, it's the green lobby. That's what got the solar panels. The real estate lobby got the real estate tax benefits. So it's lobbying, but it's really what the government wants to emphasize. The government just learned a long time ago that people hate paying taxes, A, and two, if they give people a small tax benefit, then they'll get a big reward. Because remember that you get a deduction now, you might have to pay tax later. The difference in real estate, you really never have to pay tax. So that's a whole different discussion, Tom. You really don't have to pay tax in real estate ever. But you're still doing what the government wants done. You're still doing social behaviors that the government wants to encourage, and they do it through the tax law. That's where most of the social behaviors come from that they want to encourage in the tax law. And that's what makes the tax law fun. And that's what makes this whole thing so interesting.
I tell you, yeah, you've taught me for years. Just don't try to swim upstream. Just follow what the government wants you to do it by their rules, and they reward you with low to no taxes.
There you go.
And I can tell you, folks, what he says is true. It's pretty fun. And you mentioned the solar panels in a previous day. Is that a timed? Is that gonna
phase out?
Die out. Phase out. Thank you.
Eventually, yes, but it's good through 2032. So it's a 10-year. It's a 10-year rule.
Nice.
And it's. I mean, they're enormous. I mean, the tax benefits are. If you actually leverage it, you can actually get a return on your investment day one. So you get all your money back day one. If you leverage those solar panels. But it really, especially if you're in an area that has a lot of sunshine and high utility bills, like I am in Arizona. In the summer, we get high utility bills. I've estimated, I put solar on my business building, and we've estimated that my return on investment is going to be somewhere around 22% on those solar panels.
Nice. Tom, can you explain to the audience a little bit the difference between a tax deduction and a tax credit?
Absolutely. So a tax credit is dollar for dollar. So if you get a $3,000 tax credit, you've lowered your taxes by $3,000. So like on my building, I put $100,000 of solar panels on my building. So I get a $30,000 credit. So that means my taxes this year, they just finished putting them on, my taxes this year will go down by $30,000. That's a credit. Now a deduction comes off my income. Now we all have an income tax bracket, and it could be anywhere from, frankly, there are 0% brackets all the way up to 37%, 40% if you're a passive investor. So in my case, for example, let's say that I've got that $100,000. Well, I don't get to deduct the $100,000, but I am going to get to deduct about $65,000, which means it reduces my income by $65,000. But remember, we have a progressive tax rate. So the first dollar of deduction comes off the highest income, which means if I'm in a 40% tax bracket and I get a $60,000 deduction, that's worth $24,000 in tax to me. Okay, so that's literally how it works. You take your tax bracket times times the deduction, and that's your tax savings, whereas a credit is dollar for dollar.
So now you got $54,000 in your pocket, and if you leverage that solar at 50% LTV, you're in
right.
for no money down.
No money down and $4,000 in my pocket. Yep.
Oh, that's awesome. So you said something else when you talked, and I know it always throws up red flags, and depending on which CPA some people talk to, they'll always say, don't try to deduct that home office. That's a red flag, Tom. You don't want to alert the IRS. What do you say about that?
Well, first of all, if you do it the way the IRS would like you to, you never alert the IRS in the first place. Because the only way you're going to alert them is if you have a sole proprietorship, which goes on your Schedule C on your 1040, or you're putting your real estate on your 1040. And so now the 1040 actually has a form to say, here's my home office. Well, if I instead have my business in an S corporation, or I have my real estate in a partnership, I don't have a separate form. What I have is I get reimbursed for my home office. That reimbursement is tax-free. On the S corporation tax return or the partnership tax return, that's just an office expense. So there's no red flag. I mean, literally zero red flag. And I'm telling you how the government tells you to do it. So this isn't like some loophole or anything. I'm telling you, this is the way the government wants it done. They would rather you be an S corporation or a partnership than a sole proprietorship, because that's a better way to operate. And they'd rather that you actually operate like a real business. And if you operate like a real business, you get tax benefits like a real business.
That's right. That's the key. Operate like a business. Well, let's see if we've got some questions. Tom, are you going to share your screen anymore?
No, you can take it back.
All right, I'm going to take it back. Hopefully that works. Yeah, you're still there. That's awesome. We're going to look at what questions we have. All right. Somebody says, my CPA said cost segregation only goes against passive income, not W-2.
Well, and let me give you a better answer than that. So there's always, we can ask yes, no questions, like, can I take the cost segregation deduction? That's a yes, no question. Or we could ask the question, how do I get my real estate losses? How do I get that? How do I get that deduction? Not is it deductible, but how do I get that deduction? So the question is not, is it passive? It could be. If you're talking about a passive investment, like let's say you're passively investing in Presario, then the deduction is passive. There's more though. First of all, one of the keys is create passive income. Now, again, I said, if you don't have a business, you're not going to get the same tax deductions as somebody with a business. So with a business, it's very easy to create passive income. Very easy to create passive income. But let me give you another part of that. And that is, so that deduction is an ordinary deduction. And yes, it carries over. If you're passive and you can't do anything about it, you haven't figured out how to get there, then yes, it's passive. That means it carries over until you sell the property. Well, when I was watching those slides, Tom, I saw 4 years and 3 months. That's the average. So that means that 4 years down the road, what's going to happen is there's going to be a sale. When there's a sale, those losses now are available to you 100%. They're no longer passive. And they can offset your W-2. Okay, those losses can now offset your W-2, which may be taxed at 37%, right? So you've got these deductions at 37%, but when the property is sold, you're going to get taxed at capital gains rates, which is a 20% tax rate at the highest. So you're actually getting the spread between your top marginal rate, say 37%, and the capital gains rate, say 20%. Now, if your marginal rate's lower than that, your capital gains rate is also lower. So that means your marginal rate may only be 33%, but your capital gains rate may only be 15%. So you've still got this spread in the year that the property is sold where you're picking up capital gain, but you're reducing high taxed income. So one of the things we always want to look at is, how do I get rid of my high taxed income and only pay tax on my low taxed income? And investing in real estate is one of the ways to do it, because while it is passive, the first year, when I sell that property, it becomes an active loss. I can use it against my W-2. And at the same time, I only have to pick up gain at capital gains rates.
That's wonderful. And, if you look at Robert's cash flow quadrant, You just have to find a way to move from the left side to the right side. And it's not that difficult. You set up an LLC and you've got a business, right? You can start small. It doesn't have to be a big business to at least get our way over there. And you always, I learn every time I listen to you, even though we talk all the time, I'm still learning new stuff. All right, I have a question Are W-2 employees, this is a physician, are W-2 employees like physicians allowed to take tax deductions from solar panels against their active income?
Well, this is an interesting one. So the credit, that 30% credit, you can use that against any income tax. It is not subject to the passive rules.
Nice.
The deduction for the equipment is subject to the passive rules. So the answer is yes, you get the credit. The deduction for the depreciation, you're going to get that as you create passive income or when the project is sold down the road.
Awesome. And this one, I'm going to ask this maybe. He also asks, what about movie investments?
Well, movies, that's likely to be passive, right? Okay. But the good news is, hopefully you invest in a movie to make money. And so when you make that money, you'll get that deduction. It carries forward forever. You don't lose it. And this is one of the injustices that tax preparers and tax advisors do with their clients is they say, well, it's passive, so you don't get to deduct it. That is false. That is a false statement. The better statement would be it's passive, so we cannot deduct it yet, but we will eventually be able to deduct it, which that means that you will get that tax benefit and you will be able to offset. Now, we do have a new law, and the new law says only $500,000 of W-2 income can be offset by those losses. Now, I'm going to still give you good news, because when that movie produces income or when that real estate is sold, that's going to be business income. And business income frees up all of those losses that you can use now. Now you don't have a $500,000 limit. And the $500,000 limit is really just a 1-year limit because it becomes a net operating loss, and then it can be used the very next year. And in fact, it can be actually very useful to you that you've got this net operating loss carry forward. At that point, you can use it in the future.
And you make a good point. A lot of people will say, well, gee, I don't have any passive losses yet. I can't use it. And anybody that's on this call is already on that track to get educated and to invest and to eventually have passive income. So we don't want to keep them from not gathering those losses, even if you can't use them now, because as Tom says, they can be used anytime. They won't get lost. We do have somebody that has asked something that we will do. Please share the info on CPA firms network using your strategy. We are going to add that. We will have that link and that information on here. We'll get it on there. So we'll put it in the notes, or how will we do that, Robin?
We'll have to send it out.
We'll send that out. We have that information. We will send it out to everybody on this webinar. So, other questions? I think we have that, Tom. So, it keeps changing. I mean, you and I talk fairly frequently. I know you presented to another group recently, and I learned something there, and I learned something brand new this time as well, always. See, folks, Tom loves that. Tom is one of those guys that actually reads the tax code. And when we talk as a client, it's fascinating what can be done and what the government wants you to do and makes available to you. And you just need somebody like Tom or the firms that he's educated and trained to look for those. Just a plug. This is sort of a plug for everybody and somewhat for Tom or for him. But I had a really good CPA, very good CPA. It was my dad's CPA. So, of course, that's the guy I used. And over time, I would listen to webinars like this. And I was friends with Tom. I wasn't working with him yet, but I was learning things. And I'd go back to my CPA and say, hey, can I do this? And he'd say, sure. And I'd say, well, why didn't you tell me? He said, well, you didn't ask. And so it's really nice to have somebody. I would suggest to everybody, try to connect yourself with somebody that's proactive, a proactive tax strategist, not just a CPA who does your taxes, because the savings and the income that you will derive are pretty significant. It's nice to pay zero taxes when that opportunity is given to you.
Yeah. So maybe I can add a little bit to that. So the other thing is you don't want to rely on a single person. Okay. I never want to rely on a single person. So we have a network of 65 CPA firms. If I have I'm not an international tax expert, but I have members in my network who are international tax experts. So I can go to them. So first of all, don't ever rely on just one person. You don't want to just have one person, because there's no way you know all the answers. I mean, I get stumped all the time. I have to look it up, right? So you don't want to rely on one person. You want to have a whole team of people. Tom's basically got a team of 65 CPA firms that we can go to besides my own staff of, 12 or 13. We've got an entire network. So we've got hundreds of CPAs to go to. Second of all, the person I think is less important than the system. So most CPAs answer questions like you said, Tom. You ask a question, they'll answer it. Well, but they have no system for strategically and permanently reducing your taxes over a long period of time. There's no system for doing that. They haven't created some formula that says, well, if we do this, this, and this, we'll end up here. And that's what we've done with our network is we've said, look, we'll create the system. We are great at creating systems. And our CPAs are really good at following the system, but they're not good at creating a system. So I wouldn't tell you that our CPAs are the most brilliant CPAs. I'm sure there are CPAs who know more than I do, but I will say that our CPAs have the best system. And so they will follow that and it will be consistent. And that's how we get consistent results. So I think those are two things to remember is first, you don't want to rely on one person. And second of all, you really want to have a CPA that's got some kind of a system that actually understands, you do this, this, and this, and you get this result. So it's, and the third thing I would say, Tom, is, you make a good point. CPAs, in fact, most advisors expect you to ask them questions. But if I were to come to your office when you were a doctor, Tom, I would suspect if we took, and I said my shoulder hurt, I suspect you'd spend 15 minutes asking me how it hurt, where it hurt. You'd be asking me all the questions. I wouldn't be asking you questions. You'd be asking me questions because you're diagnosing the problem. And then once you've diagnosed it, it's an easy solution, right? Oh, you need surgery or you need this, you need that, you need a shot, whatever. Same is true with a tax advisor. I mean, really, if you're asking all the questions, you really need a different tax advisor because they're the ones who should be asking you the questions. Because the answer always is, if you ask a yes, no question, the answer 100% of the time is it depends. But if you ask a better question, like not is it deductible, but how do I make it deductible? Then it's just a matter of, like we like to say, you change your facts and change your tax. And that's where you have to go with it.
I tell you, yeah, said nothing better than a network of brain power to help you. And I tell you, folks, tax savings is money in your pocket today. It's really something. We've got quite a few questions now. Can you please explain how the bonus depreciation gets recaptured after, say, a 5-year hold?
Well, generally speaking, you have almost no recapture after 5 years. Because remember, the government said that the contents wear out after 5 years. So technically, you have no value after 5 years, according to the government. So there should be no recapture of the 5-year property. And then what about the land? Well, the land improvements and the building. Well, but they only get recaptured at a 25% rate. They don't get recaptured at your ordinary income rate. So you still have a spread between your ordinary tax rate and your capital gains rate, which is lower. Even when it's depreciation recapture, it's lower at 25%. So if you're paying a lot of tax on recapture, then there's something wrong with how you're actually doing the transaction or reporting it on your tax return.
Gotcha. All right. Does the tax credit come to those who invest in oil and gas royalties is that separate from 14% depletion on the wells?
All right. So this is energy, but this is a different kind of energy. This is fossil fuel. And I have the advantage of having gone to school in Texas. So I actually know something about oil and gas. So there are big tax benefits for oil and gas. Basically, pretty much 100% of the money you put in, you get to deduct within the first couple of years. That's not a credit, that's a deduction. So if you put $100,000 in, you get a $100,000 deduction. Okay, so that's worth at most $40,000 to you, right? 40% tax bracket. Now there is depletion, and it's actually a 15% rate. And 15%, what this means is only 85% of the income from the oil well is taxable. So you get an automatic haircut on the income. So you actually got to deduct all of your investment, and you only pick up 85% of the income. So it's pretty cool.
Nice. Yeah. Oil and gas is wonderful. Okay, another one. Did I understand, just a clarification question, did I understand that with the installation of solar panels, you're allowed a 30% deduction of the cost the first year and a 30% tax credit? I think it was 60% deduction.
It's a 65% deduction and a 30,000 and a 30% tax credit. So it's a 65, it's percentages, right? So you don't get a $30,000 deduction no matter how much you put on, right? You get 30% of whatever the cost is of the panels plus the batteries, including the installation costs. You get 30% as a credit, dollar for dollar. And then you get a 65% first year deduction. And then you get some deductions after that too, because the rest of it is deducted over 5 years.
And that's 65. If I put 100 grand in, I get 30,000 tax credit. Then do I get 65% of the full 100 grand for my deduction?
Yep. Correct.
Okay.
Correct.
Nice.
That's the net of the number. Yeah.
Okay. Here's one. Do IRS rules for bonus depreciation make it so that a cost seg needs to be taken in the first tax year an asset is put in use, or can it be done later in the life of the property?
That is a phenomenal question. And the answer is generally yes. The IRS has ruled actually that you could do the second year. So you could actually, that they give you a year leeway to do that cost segregation and take that bonus depreciation. I always suggest you do it in the year you place it in service. If you do it after that second year, then you're not going to get bonus. You'll get the 5-year, 15-year, but you won't get the bonus.
Gotcha. Now we are going to send out information, folks, on how you can contact Wealthability. But question: do you have a CPA firm in Houston?
The answer is yes. We have CPA firms all over. We do have CPA firms in Houston, but I'm going to tell you, we rarely match people according to location, because chances are you're not going to spend a lot of time sitting down face-to-face with your accountant. Nobody really wants to spend a lot of time face-to-face with their accountant. Let's just be honest about it. What we'd rather do, and this is the great thing about Zoom, what we'd rather do is match them to your situation. So what we want to do is, if, for example, I see one, they said, well, I have a CPA who does real estate, but I need somebody who also does energy. So if you need both real estate and energy, then we need to find you a CPA who understands both real estate and energy. And that is not common, by the way, particularly fossil fuel energy. That's its own specialty. Real estate's its own specialty. To find somebody who does both, I am just fortunate, because I actually spent my early years in Salt Lake City during the gas boom days of the 1980s. So I personally have a really good handle on oil and gas. So you do want, what we want to do is we want to match you up. We want to match you up with the CPA who understands what you need and is at the level you need. So one of the reasons we did a network is because we found we could handle the Tom Burnses of the world. But what about somebody who's just starting out? Okay, they couldn't afford, to hire, this really high-end accountant. So what do? Well, they have to, how do they get good information? Well, what we have now is, of our 65 firms, some only work with people who are just starting out, and others only work with high-end investors, and others are in between. So we have a really nice mix now. So we can get people to the right CPA. if it needs to be in your location, that's fine. But since Texas doesn't have an income tax, probably not as important. What's probably more important is that they, can do the things and understand what your business is all about.
Good point. I can tell you, folks, I'm in Austin, Texas, and Tom's in Phoenix, and we've been working together for a number of years. Well, Tom, stick around for a second. I'm gonna share my screen and kind of close us out. How does that sound?
Sounds good.
All right. So I just want to close with a little information on the current Presario project. So many of you may know we have already raised one tranche for the extended stay portfolio. We are now into the second tranche, and this is a portfolio of 6 properties, geographically diversified. We've got 1 in Georgia, 2 in Alabama, 2 in Texas, 3 in Texas, excuse me, 1, 2, 3. That's right. We've got Schertz, 2 in Waco, 2 in Huntsville. We got 1 in Duluth, Georgia. So this is available now. Really excited about it. It's essentially works a lot like workforce housing. People stay surprisingly over a third of the people in extended stay over 30 days. Our current project's targeting a 14% true cash on cash return, 1.9 targeted multiple, and 16% IRR. We like the diversity. We love the partner. We love the product. It did very well during the pandemic, very resilient asset class. If you're interested, as usual, you can click on this QR code, or as always, contact us at info@presarioventures.com. Tom, I am so excited. We're so blessed to have had you. And I think we could have gone, the questions were rolling in, and they're still there. I think we could have gone for another half an hour, but we have to respect your time and the time of the folks on the show. And so thank you so much.
Oh, happy to do it, Tom. Really, this is my mission in life. My goal is to make taxes fun, easy, and understandable. And that's sometimes harder than you might think, but it is the goal. And it can be
better than anybody. I encourage everybody on the call. Tom's got 2 great books. Tax-Free Wealth is something I've read multiple times. And the 7 investments the government wants you to make. I'm close to that. Sorry, Tom. What's it called again?
Called the Win-Win Wealth Strategy. 7 investments the government will pay you to make.
All right. Okay. So that one too. I've read that one twice already. So I encourage y'all to get that. Tom, thank you so much. I'll see you in person here in about 6 weeks.
Awesome. Look forward to it.
Take care, guys. Bye-bye.